I'd like to start with, a question for Dr. Anantha Nageswaran. I would love it if Navneet and Renuka, if you could add to that as well. How do you see the evolving relationship between the public and private sectors? Now, how do you see the role of the government in, recently the Finance Minister, Ms. Sitaraman, talked about crowding in the private sector. But if you look at it from a 5 to 10 year view, how do you see the relationship evolve?
No, the crowding in aspect comes in the short term. The crowding in comes in the short term where, because the private sector is still relatively hesitant and justifiably so, given the lack of demand visibility. So the crowding in of the private sector's investment will happen if the government provides the initial thrust and continues to keep the capex happening on infrastructure sectors. Then hopefully private sector will step in, let's say, after 2 quarters down the road, when there is greater clarity about the underlying demand, etc. That is the current crowding in part. But from a longer term perspective, I think during the pandemic years, the government made it very clear that even only in strategic sectors, the government will retain some presence, and that to few enterprises, and in many of the non-strategic sectors, it would make complete withdrawal. So the expectation is that the private sector will grow in size much more so in the non-financial space, and even in the financial sector, the current share of the public sector in terms of assets should diminish over time, and private sector should be the dominant share. As if by the end of the decade, I think it will be both financial and non-financial corporate sector will be more dominated by the private sector participants rather than the public sector entities, including in the so-called critical sectors.
Thank you, sir. Navneet, would you like to respond?
I'll just make one comment that, as I say, that you don't realize when you're part of history. I think the Air India Maharaja returning back to House of Tata is such a big moment. The reality hasn't really sunk in, the relationship between the public sector and private sector. There's this famous saying, and maybe I can relate to like what happened in US in 80s, and of course our economics today, and what Anantha, my dear friend, is the chief economic advisor, is not the same economics as what Reagan pursued. But I think we can relate to when he said that government has no business to be in business with less government, more governance. I think that's more important, the ease of doing business or creating a conducive environment for private sector to flourish. And I'm sure, I think over the next several years, some of the things that has happened over the last few years will give, I think, a lot of courage and conviction for the private sector to keep investing. Anantha rightly said that at this stage, the government has to do the heavy lifting, and that's why there was big focus in the budget, and I hope over the next several quarters to kickstart the public spending. But I'm pretty sure about one fact, that it will be followed up by the private sector business spending as well.
Thank you. I want to add an anecdote. Recently, we were in an internal review within the bank, and the MD told us that you should see the way in which the government is operating. This is the first time in my career that I've seen us being told to emulate the speed of decision making of the public sector. I think that speaks for itself. Being at HDFC Bank, I never thought that we would actually ever hear that, but it's commendable. Renuka, would you like to comment on this?
Agree with what both the other panelists have done. To take another example from the same Tata group, Tata Communications, which I have the privilege of chairing, government turned out to be the smartest investor, divesting at the most appropriate time. And I think the private sector allowed government to monetize something that they have right from BSNL time. So I think more than collaboration, I think everything that has been said, government will have to invest in the infrastructure. The private sector will help government come out of enterprises that they don't wish to be, in the ensuing years.
I'll hold that thought. I'll just ask you a question. How do you see the role of the private market and private capital in the evolution of India? And from that perspective, eventually as part of the retail wallet, where do you see it actually evolving and finally landing?
Thank you. First, good evening. Real privilege to be here. Thank you, United Way, for giving me this opportunity. Private equity, venture capital continues to be a topic which deserves some demystification. I started my career in private equity more than 25 years back. And at that time, the question used to be, you know, what is private equity? What do you really do, right? And why do you exist? Those days, the amount of money that used to come into this sector used to be less than $1 billion per annum. And it peaked at $77 billion in the middle of COVID last year. So the entire capital for rejuvenation, recreation, reimagination, innovation in corporate sector is coming from private capital. And we have had multiple disruptions. I think technology has led most of those disruptions. And governance, demands of capital markets, demands of becoming globally competitive businesses has also led to corporations having to completely rethink their business model and becoming globally competitive. For all of this, capital market is not the solution provider, because capital market puts the companies on quarter performance, and they need highly predictable results. So I think that private equity venture capital is going to be at the center of the creation of India going forward, much as the role that it has played in other developing economies. So from less than $1 billion 20 years back to 77 billion now, as an industry, we are working towards how do we take this to 100 billion in the next 5 years. And therefore, all the transformation, the digital-led transformation that we have seen in the last 5 years, there's so much sound about unicorns. You know, unicorns apart, I mean, if I just look at the number of new companies and the amount of jobs that have got created, it happened because of this industry. Now, coming to your second part of private participation, if I look at the share of public market to private market cap 20 years back, it would have been less than 1 or 2%, the private market capitalization, and in India particularly, because India has always had a very vibrant stock market. Today, I get tickled when I started my career in mid-80s. I used to take companies public which had a turnover of 50 crores, not PBT of 50 crores, right? And the largest issue at that time was Indo-Gulf Fertilizers of 60 crores or something, and we thought that we have conquered the world in taking such a large company public. Therefore, there was really no private market capitalization. Today, this number stands at close to 20%. We have a public market cap of about $2.6 trillion. Private market numbers are never that accurate, but it is estimated that the private market cap is about 500 billion. Now, clearly, I think the personal portfolio has to mimic the market opportunity. Otherwise, you are making a conscious choice that I want to only swim in the pond, which is approximately 80% and shrinking. Now, if I fast forward this to 2030, I'm very confident to say that this ratio will be 65-35 between public and private, given the rapid change that is happening in the private market. And that makes an argument as to why individuals and family offices should have private products in their portfolio to benefit from the entire value creation story of the economy and not restrict themselves and not disallow themselves from the opportunity of the private market.
Navneet, would you like to talk about how you can see that evolve within the asset management industry, the proportion of money going into the private markets?
So on 1st of January, had I told you that there is going to be a war of the scale that the world hasn't seen since Second World War, the oil might touch a high of $140, so on and so forth, you would have said that then markets are likely to fall maybe 10, 15, 20%. If you go in any historic episode of foreigners selling $17, $18 billion, markets would have fallen like in a much bigger way. But the fact is Nifty is almost flat YTD. And the reason is domestic investors like us have continuously been pumping money into the markets. And thanks to the, what I call the 401k movement of India, this whole SIP revolution, mutual fund sahi hai, the smaller SIPs that several of my colleagues here have worked hard over the last several years, that today we get over 11,000 crores per month through the SIP flows, and this number is likely to increase because even today we have only touched 2.5% of the population in India. There are only 30 million unique accounts that the mutual fund industry has got, and of course, a couple of years back when EPF also started investing into equity, so we have a long way to go. So I mean, as she said that how the private markets have come of age, I think even on the public side, the sheer influence of the domestic money will go a long way in ensuring that our vulnerability on, historically our markets have always danced to the tune of global risk appetite, global liquidity, global rate, and the global situation. But I think that vulnerability over a period of time is likely to come down.
So let me ask you a specific question on this, because there are two schools of thought currently. There has been gross outflow since October of 26 billion US in the amongst the FPIs, net outflows of around 20. Now, one school of thought is that all of this is being absorbed by the domestic mutual fund industry. But as this continues, if this continues to go on, then at some stage, there is going to be selling on this side as well. So do you see that point coming in the near future?
It's very difficult to predict the market in the near future. I mean, as I said, if you had a crystal ball on 1st January of this year, if you had a crystal ball on, let's say, 7th or 8th of February 2020, when Nifty touched a high of 12,000 and volatility was at its lowest level in decades across all markets, equity, fixed income, commodity, and currency. And had I told you that we are going to see a health crisis which hasn't happened in a century, 6 million people across the world will die, and that's an official number. We are going to see an economic recession which we haven't seen in decades. And in India, we are going to see the worst economic recession ever. We are going to have a social crisis, right from rising inequality to Black Lives Matter to maybe migrant crisis. We are going to have a geopolitical crisis which is like India-China conflict or US-China trade war and what has happened recently. And the worst possible climate crisis, the number of erratic weather events that have happened globally in the last 2 years. Again, you would have said that maybe markets would be substantially lower. The fact is we are substantially higher. There are a variety of things at play. I think from India's perspective, and of course Anantha talked about the government's commitment to the reforms, but if I add RBI's resolute approach on supporting the growth, and of course with the $630 billion of war chest of managing the external sector in a realigned geopolitical world, I think India, I mean strategically, whether you are a politician anywhere, whether you are a business leader, whether you are an investor, you will look more favorably at India. In a digitally redesigned world, I think India turning from the most data poor society to the most data rich society, you feel a lot more positive about the country. I think the new investment cycle, as Anantha mentioned earlier, driven by the government capex, followed by the private sector, I think it's just starting. My boss, Mr. Parekh, has said, and he has the most experience on real estate than anybody else, that he has not seen in last 50, he has never felt as positive about real estate as he's feeling today in last 40 years or so. So a new real estate cycle, a new investment cycle. And I think in last 2 years, what comes across, what gives us the most, I would say, confidence is the resilience and the resolve of corporate India. I think it's the resurgence of corporate profitability that we are going to see, driven by a variety of factors, whether it's the rates, whether it's the taxation, whether it's the cost rationalization and the innovation that the corporates have done, and all the other things that investors like her would have pushed entrepreneurs to do. With all of that, I feel quite positive about, a structural story, but there is no way to predict markets over the next few months. The only thing I can say with full certainty is continuity of uncertainty.
I think you made a very interesting point about corporate profitability. Even now, we are only halfway back to the peaks that used to exist even before the pandemic. So we have a long way to go. We at HDFC Securities are of the same view. Dr. Nageswaran, since we are talking about private and public capital, how do you see the evolution of the way in which the government participates in capital markets and in the private markets over the next 5 to 10 years?
So, the government obviously looks at the capital market as an important instrument for monetizing many of the relative unproductive assets that it has, and second, obviously, to divest itself. And also now, by offering the government debt instruments directly to the retail market through RBI, so the government is actually, and also creating new financial innovation products like InvITs, etc. The government clearly looks at capital market as an important instrument in the investment mobilization that needs to happen in this country for the next 10 years. At the same time, we should remember that banking sector, and as Mrs. Renuka Ramnath mentioned, private markets and private equity, venture capital will have to play an important role, no doubt about that. Banking sector will remain indispensable. And if you look at the development history of today's developed nations, most of them grew on the back of bank credit. Capital markets came in the wake of economic development. They didn't precede economic development. So there are limits to how far you can rely on capital markets alone. But we can't have either or solutions. We need to have all of them. And the government clearly is not putting its eggs in only one basket. So capital markets will be an important vehicle for monetizing and for raising productivity of government public assets. At the same time, I think bank credit will continue to play an important part with respect to infrastructure and investments, both by the private and by the public sector.
Just hold that thought. Navneet made a very interesting point about not being able to tell what happens in the short term. At this point in time, there seems to be a significant amount of confusion. You read research reports all around talking about how it's a high inflationary environment. There are some who say there is a stagflationary environment, and then there is a third school of thought that we are actually in a multi-decadal deflationary environment, and this is just a short spike. Now, I would be very wary of using the word transitory because people have gone very wrong doing that last year, including me. But where do you see this settle? Which of these three scenarios seems the most likely to you? Inflation, deflation, stagflation.
So, speaking for the developed world, I would say in the short run, I think for the next 1 to 2 years, a stagflation probability is reasonably on the high side. Inflation, subsequent to that, we need to accept that the last 40 years of low inflation were driven by special factors, which was rise of China as a low-cost producer, globalization in general, and in general, the balance between capital and labor shifted more in favor of capital and less in favor of labor. I think that's a cycle that has run its course. And in the course of this cycle, the developed world accumulated so much of debt as well, which cannot be financed by growth alone, because the best growth years for them are behind them. So therefore, as Professor Charles Goodhart and Manoj Pradhan have written in their very important book, The Great Demographic Reversal, I think we should expect that among many things, advanced nations will rely on inflation also as a way of handling their debt burden. So I would therefore, personally, I'm not wearing my investment strategist hat right now, but I certainly think the risk of inflation is higher than the risk of deflation in the advanced world in the medium term.
Okay, so just to summarize, so what you're saying is that the cloud of finance is so big now, I think probably 4 or 5 times GDP, that that kind of starts to come off in a deglobalized environment, which leads to higher sustainable inflation over a longer period of time. Is that?
Inflation would be one of the mechanisms through which debt to GDP ratios will come down. And if you look at our own recent history, between 2008 and 2013, we had 5 years of double-digit inflation, and growth was kind of coming off after the heady years of 03 to 08, but yet our fiscal deficits were high. But yet our debt to GDP ratios came down, public debt to GDP ratio came down, and that is because nominal GDP growth was going much faster due to inflation. So the developed world basically reduced its debt burden post-World War II through a combination of growth and high inflation. But this time around, it will be more through inflation and less through growth.
Thank you. Navneet, would you?
And I think, yeah, as he said that, I mean, as Mark Twain said, that history doesn't repeat, but it rhymes. I think is exactly what happened after the 40s. The level of public debt in the world, it can only come down if we work on the denominator, right? Which is like nominal GDP growth, which is a combination of your real growth plus inflation. And I think inflation is badly needed to sustain for an extended period for the public debt levels as a percentage of GDP to come down. I mean, it should not reach a level where we don't have a growth. Stagflation could really be very worrisome, but I think that's like higher than what we have seen in last 10, 12 years, higher than the trend line nominal growth plus inflation is really badly needed. It's just that, I mean, in a large part of the world, somebody was asking me about the inflation in India and rest of the world. So Anantha, I said that these guys have forgotten the textbook. They don't know how to deal with inflation. We understand it extremely well because every few years we have these bouts of inflation and our policymakers understand it extremely well. For more large part of the developed world or industrialized world, I think it's not there. They haven't seen it since 1980s. So it's going to be very difficult for them to deal with an animal called inflation.
No, so that's the follow-up question, right? Because if the governments are not used to seeing this, is there enough political will to allow the central banks to be able to allow inflation to fester for a bit before it comes off? Because it has other implications, right? It's just not pure economics. Any view on that? You and then I would invite both of them to comment. Renuka, you want to take that?
So I think it's, while since 2008 we have lived in a world where every time there is any challenge in any part of the world, central banks come and solve that by printing more money and by cutting rates. It's like treating the hangover with more alcohol. It's some day that has to kind of an end, and thinking that this time again, even a higher inflation, and because of that, if asset prices go down, you can treat that with more liquidity and running such high negative real rates. There are going to be political repercussion of that. I think the savers will get punished so severely, it will have its backlash somewhere.
Yes, please.
No, I think you are right that it will definitely have consequences, but but policy making is about choosing trade-offs, and reducing the debt burden is an important policy imperative in the developed world, and so therefore they will have to transfer resources from savers and pensioners to the borrowers, because once you have such a high debt burden, low interest rates become a trap. It's very difficult to get out of it, which is what Japan has been in for the last 30 years. And I'm afraid that much of the Western world may also be heading into that phase because of the kind of debt burden that's been accumulated. And therefore, I feel that this is more likely scenario than one where we have the Goldilocks of low inflation and moderate growth, which we all got used to in the 90s and the new millennium for some time. But that, I think, is more likely to be one for the history books.
So,
Sorry, although I said I don't have a view, I definitely don't have a view on how those governments will handle it, but I have a solution. So the way some of the developed economies like Canada, for instance, are handling this is by allocating more money to alternative assets. So the best way to beat inflation is just make more returns. And while I said it frivolously, on a more serious note, if you look at Canada Pension Plan, it's there on their website, which is one of the largest pension funds, they started with an allocation for alternative assets at a minimal 3% somewhere in the 2003, 2004 timeframe. And in 2021, they are at 28%. And they have a stated goal of going up to 30%. So I guess high inflation is unavoidable. High inflation, both the panelists have agreed, is desirable to keep the debt to GDP. And therefore, high returns is a must. Yeah.
So on that note, I'll since we are on the topic of higher returns on alternatives, at this point in time, I think the dust has still not settled on what's happening in the tech industry, so as to speak, because there has been a global correction in tech stocks, which is obviously putting pressure, at least intuitively, on returns being made in the private market on the tech, because that's where bulk of the capital is held. in this kind of scenario, how do you expect to see the exits from the private capital, incremental investments into the technology, let's say loss-making, long-duration assets like technology, and the way in which you will eventually look at valuing them and monetizing them eventually?
So, as you know, there are many methods of monetization. First, I think the biggest advantage in the private market is that money is with responsible investors who also have an influence, unlike in a public market where taking, let's say, corporate action in a public market is a lot more challenging because you have to bring so many people together, and it also comes at a huge expense of value destruction. In the private market, therefore, our ability to discipline the company in terms of, in the middle of COVID, what did all of us do? Hey, are you funded enough for your business plan, right? And don't chase valuation, but just chase liquidity. And the company who's going to be left with liquidity is going to be the king. So there are mechanisms in the private market whereby you create holding power for yourself. Second, if you again look at the stratification of fund managers in the private market, you would see a huge emphasis on this top quartile fund managers. So top quartile fund managers over several decades have figured out what are the right strategies to invest behind and how do you build valuable companies against all odds that may happen in the market. While the last decade we have seen a lot of exogenous shocks, it's not that in the previous 2-3 decades there have been no shocks. And if you look at some of the most reputed, high-performing, top quartile fund managers, against all exogenous shocks, they have delivered higher than public market equivalent. That is because of the direct influence you have in the company in terms of how the company will navigate itself through these economic challenges. Therefore, I do worry about mortality, much higher mortality in the coming 5 years relative to what we may have seen earlier, because there could have been a lot of investing that may have happened without looking into the distant future by just looking at valuation uptick, which would teach a lesson. And that, like in every other industry, allows the top quartile performers to become even stronger. And that's what we survived and lived through the COVID time as well. When COVID hit, I thought all hell is broken loose. Every company is going to bleed, and there is going to be no capital to invest behind them. And some of our loss-making companies became profitable in COVID by just tightening the belt. And the influence the shareholders have in terms of, hey, let us look at facts as facts and not as from a wishful, thinking lens, and really cut down costs to, the bare bones can happen in the private market. So these are some of the mechanisms by which I very strongly believe that the top quartile managers in bad markets do even better than in good markets.
Navneet,
In India, we didn't have the kind of excesses, if you are referring to that tech meltdown, the excesses that we saw in other parts of the world. So if you look at US in NASDAQ, there are 3,000 stocks. Roughly 45-50% of them are down 50%. 20% of them are down 75%. Several of them are down 90%. There were around 130-35 IPOs last year. I think except 5 or 10, all the IPOs are below the issue price. And the SPAC and all the other things that happened without taking names, I think those kind of excesses, thanks to the environment here and the, sometimes people don't like it, our policymakers are too conservative, but that has kept us in good stead.
Dr. Nageswaran, would you like to add a comment? We are at our last question.
No, I'll take a pass on that one.
Okay. I think we'll have to wind this up. We could have gone on for another hour. It's getting very interesting, but unfortunately we have a time limit. So thank you very much, Dr. Nageswaran. Thank you, Navneet. Thank you, Renuka. And thanks everyone for listening in.